Think index funds are the safest way to build wealth? Think again. While they promise easy diversification and low fees, there's a hidden side most investors overlook. What if I told you that the very tool designed to protect your money could expose you to unexpected risks? In today's video, we're peeling back the curtain on the hidden dangers of index funds and how they could affect your financial future. Stay tuned, because what you don't know could cost you. How index funds work. Index funds are a type of mutual fund or ETF designed to mimic the performance of a specific market index, like the S&P 500 or the NASDAQ 100. Instead of picking individual stocks, index funds simply buy all the stocks in that index in proportion to their weighting. This passive investing approach aims to match the market's performance, not beat it, offering investors broad diversification and lower fees compared to actively managed funds. Example: if you invest in an S&P 500 index fund, you'll own a tiny piece of all 500 companies in the index, from Apple to Tesla to Microsoft. The appeal: low fees. With no active manager picking stocks, fees are generally lower. Simplicity: you can track the overall market without needing to do a ton of research. The hidden risks of index funds. While index funds sound like the perfect investment tool, there are hidden risks to consider. Market volatility exposure. Since index funds follow the entire market, when the market goes down, so does your portfolio. For example, during the 2008 financial crisis, index fund investors suffered major losses because the entire market crashed. 2. Overconcentration in top companies. Some index funds, like the S&P 500, are market cap weighted. This means a large chunk of your investment might be tied to just a few mega corporations, like Apple, Google, and Amazon. If these companies experience trouble, your entire index fund could suffer more than you expect. 3. Limited flexibility. Index funds are passively managed, so if certain sectors or industries fall out of favor, you can't shift your investments quickly. For example, energy stocks may decline rapidly due to environmental regulations, but an index fund won't adjust to avoid those risks. 4. Potential for lower returns in certain markets. In booming or highly speculative markets, actively managed funds may outperform index funds because active managers can make strategic decisions to capitalize on trends or avoid downturns. 5. Investor herd mentality. When everyone is investing in the same index fund, it can inflate prices and create a bubble. If too many people follow this passive approach, the market itself can become less efficient, and corrections can be more severe. Different types of index funds. Not all index funds are created equal. Here's a breakdown of the most common types. 1. Market cap weighted index funds. Track major indices like the S&P 500, where stocks with larger market capitalizations, biggest companies, get the most weight. 2. Equal weighted index funds. In these funds, all companies get equal weighting, regardless of their size. These can reduce over-reliance on large cap stocks. 3. Sector-specific index funds. Focus on a specific sector, such as technology, healthcare, or financials. They allow you to concentrate your investment in industries you believe will grow. 4. International index funds. Provide exposure to companies outside the U.S., helping to diversify your portfolio with global investments. 5. Bond index funds. Instead of stocks, these funds track bond indices. They offer a more conservative, income-focused approach. Building wealth with index funds. Despite the risks, index funds can still be a powerful tool to grow your wealth if used properly. Here's how. 1. Diversification. By investing in a broad-based index fund like the S&P 500 or a global index fund, you're automatically diversified across many sectors and companies. This spreads your risk and makes it less likely that a single bad investment will harm your portfolio. 2. Long-term growth. Historically, broad-based index funds have provided strong long-term growth. If you're willing to ride out the ups and downs of the market, you can build wealth over time through consistent contributions and compounding returns. 3. Low costs. Low expense ratios in index funds mean more of your money stays invested and grows over time. Over the long term, this can lead to significantly higher returns compared to high-fee actively managed funds. 4. Dollar cost averaging. Investing regularly in an index fund, regardless of market conditions, helps you take advantage of dollar cost averaging. This means you'll buy more shares when prices are low and fewer when prices are high, smoothing out your investment costs. 5. Tax efficiency. Because index funds don't buy and sell stocks frequently, they generate fewer capital gains taxes, making them more tax efficient than many actively managed funds. Conclusion. While index funds are often a solid choice for passive investors, it's crucial to be aware of the hidden risks, such as market volatility, overconcentration, and limited flexibility. By understanding how they work and diversifying properly, you can still use index funds to build wealth over time. Remember, investing always comes with risk, so do your research and consider how index funds fit into your overall financial strategy. If you found this video helpful, be sure to like and subscribe for more investing tips and strategies. Thanks for watching.